Welcome back to The Explainer. If you've been glued to the crypto markets lately, well, you already know we just witnessed an absolute bloodbath. I mean, thousands of traders were literally left staring at zero balances, probably wondering if they should have just stuck to buying, boring old index funds. We're talking about a brutal, incredibly swift drop in the price of Bitcoin. But here's the thing. Markets don't just collapse in a vacuum, right? There is always a footprint. So today, we're going to conduct a full forensic investigation into this crash. We're going to decode the technical data, analyze the exact moments the floor completely gave out, and uncover the actual anatomy of a massive market liquidation. Stick with me because by the end of this, you're going to see exactly how the market was, frankly, screaming a warning right before the trapdoor opened. Okay, let's dive right into this. To truly understand the sheer violence of what just happened, we've got to grasp the core mechanism that turns a standard everyday market dip into a total catastrophe, and that is leveraged liquidations. Basically, a leveraged liquidation happens when a trader borrows money to pump up their position. But if the market moves against them, even just a little bit, and their account balance drops below a specific threshold, the exchange steps in. They forcefully close out the trader's position to stop any further losses. They take the margin, and boom, the trader is wiped out. Now imagine thousands of traders getting forcefully sold out at the exact same second. It creates this massive avalanche of sell orders, which drives the price down even further, triggering, you guessed it, even more liquidations. It's just a brutal, self-fulfilling prophecy. And this avalanche is perfectly captured right here on the Binance 24-hour liquidation heat map. While those darker purple areas, they just show your normal everyday trading activity, take a look at those insanely bright glowing yellow and green bands heavily concentrated near the bottom right. That's specifically right around the $61,800 mark. That bright yellow line, it is essentially a graveyard of trader capital. It represents a massive cluster of leveraged long positions that all got forcefully wiped out simultaneously. The domino effect of forced sell-offs hit this zone, and honestly, it was lights out. This wasn't some gentle slide down, it was a full-blown liquidation cascade.
Section 1, the anatomy of the crash. Let's trace the breakdown. So now that we've seen the bloody aftermath, let's rewind the tape a bit. The absolutely crucial point here is grasping the sheer massive scale of this drop. Up at the top, we have our peak price, sitting high and mighty near that $74,000 level. Market sentiment was super confident, leverage was piling up, and on the surface, everything looked structurally sound. But contrasting that with what happened next, we see the devastating reality, a sudden, jagged plunge straight down into the $62,000 range. We are talking about thousands of dollars of value per coin getting completely obliterated in an incredibly tight time window. It's exactly the kind of volatility that catches even seasoned traders totally off guard if they aren't, reading the underlying signals properly. And to actually read those signals, you've got to look through multiple lenses at the same time. Looking at the 1-hour micro view, you see the short-term bleeding, right? The jagged, totally chaotic price action as the market started to panic hour by hour. But zooming out to the 4-hour macro structure, well, it tells a slightly different story. While the 1-hour shows you the immediate pain, the 4-hour shows you that the fundamental architecture of the trend was actually breaking down way before the ultimate collapse. Successful traders use both of these. They use the macro view to understand the gravity of the whole situation and the micro view to pinpoint exactly where those liquidations are hitting. Section 2, flashing technical warning signs. Let's look at the indicators. Markets rarely ever collapse without leaving a trail of breadcrumbs. Before the floor actually gave out, the charts were practically flashing neon warning signs for anyone paying attention. If we trace the chronological timeline here, the story is actually remarkably clear. Day 1, we're sitting comfortable near that 74K peak. Everything feels great, right? But then, by day 2, automated indicators start relentlessly flashing short signals. The momentum was clearly shifting. By day 3, critical structural support levels that had previously held the whole market up, they completely fracture and break down. And finally, on day 4, the momentum and the broken structure culminate in those cascading liquidations we talked about earlier, driving the price all the way down to the 62K range. The market was literally screaming a warning at every single downward step. Now, it's really easy to just look at the falling price and see the panic. But price is honestly just the tip of the iceberg. To truly get why the support levels broke and why the liquidations cascaded so aggressively, we have to ask a bigger question. What exactly was happening beneath the surface? What underlying technical indicators were driving this visible, panicked price action? Now, what's really interesting about this is what you see at the very bottom of the 1-hour chart. Pay close attention to that MACD momentum indicator. MACD stands for Moving Average Convergence Divergence. Notice how as the price starts falling, the MACD histogram dips incredibly deep into red territory, and the two lines separate widely. That deep dark red indicates heavy, unrelenting downward pressure. The sellers weren't just taking a little profit off the top, they were aggressively forcing the market down. The MACD was basically confirming that the visible price action was backed by serious institutional-level selling volume.
And if we zoom out slightly to the 4-hour chart, the confirmation gets even more dramatic. Notice the series of relentless short signals, those little white arrows pointing down. As the price moves from the upper left down to the bottom right, you see this absolutely relentless staircase-like descent. It drops, it consolidates, a short signal triggers, and it drops again. It perfectly forecasted the collapse. The algorithms and the momentum traders were completely aligned here. Every single time the market tried to catch its breath, a new wave of selling stepped right in, pushing it down the stars, getting it closer and closer to that bright yellow liquidation zone.
Section 3. Where do we stand now? Let's evaluate the aftermath. So, the leverage has been flushed out of the system in truly spectacular fashion, and the dust is finally starting to settle. Right now, all eyes across the global market are glued to one highly critical number, 62,800. This right here is the absolute battlefield. Between the 62.8K and 63.6K range is exactly where the market is desperately trying to establish a brand new floor. Traders are watching this level like a hawk. I mean, if the bulls can defend this territory, we might actually see some stabilization and maybe a potential slow recovery as the market attempts to rebuild its structure. But if this number fails to hold, we could be looking at another massive trapdoor opening straight to the downside.
Which leaves us with the ultimate question, doesn't it? Looking at all the data, the liquidation heat maps, the completely broken technical structures, the deep red momentum indicators, and this incredibly fragile new floor, has the bleeding truly stopped? Or are we just floating in the quiet eye of the storm right now, just waiting for the next massive wave of volatility to hit? The charts always tell a story, and whatever happens at that 62,800 level is going to write the next chapter. So keep a really close eye on those indicators, stay focused, and always remember to look beneath the surface. Thanks so much for joining me on this explainer, and I'll see you next time.